Hello and welcome to our YouTube channel Finbuzz Learning. So today we are going to discuss about derivatives, their types, advantages and disadvantages. So first of all we will know what does derivative means. Well, financial derivatives are financial instruments that are tied to a particular financial instrument, indicator or commodity and allow for the independent trading of particular financial risks on financial markets. Then, the two main uses of financial derivatives are speculation and investment hedging. A security with a price that is based on or derived from one or more underlying assets is referred to as derivative. A contract between two or more parties based on the assets or assets constitutes the derivative itself. Changes in the underlying assets value affect its value. Stocks, bonds, commodities and currencies are some of the most widely used underlying assets, market, indices and interest rates. Now we will discuss the types of derivatives. So there are four different types of financial derivatives. The first one is the forward contract. So, the forward contract are agreements between two parties to buy and sell an underlying assets at a future fixed date and predetermined price. Customized forward contract have a high propensity for counterparty risk. The size of the agreement is fully dependent on the length of the contract because it is customizable one. Then the next type of derivative is future contract. Now, these are just similar to the forward contract. Future contracts prohibit the buyer and seller from meeting in the person and concluding a deal. The exchange mode is used to finalize the purchase. Another type is options contract. Now, the options contract differ greatly from future and forward contract because there is no requirement that the contract is discharged on a specified date. Now, there are type of options contract which are call options and put options. In a call option, the buyer has the full authority to enter into the contracts for the purchase of an underlying assets at a defined price. While in the put option, the buyer has all the authority but do not have the obligation to sell an underlying assets at a fixed price while entering the contract. However, the buyer decides to settle every contract on or before the expiration date in both call and put options contract. And last but not least, in swap contract, among all three derivatives contracts, swap contracts are one of the most complex contracts. Swap contracts signify a private arrangement between the parties. The parties to swap contract concerned to exchanging their future cash flow according to the pre-established formula. So now we will understand the advantage of derivatives. So derivative comes with a very low transaction cost. So, we can say that they serve a risk management instruments. Derivative contracts contribute to lower market transaction cost. Derivatives are also used in risk management or risk hedging. The price of the underlying assets directly affects or derivative contract's value. Thus, the risk related to fluctuating price levels of the underlying assets are hedged using derivatives. The other benefit of derivative is that they are market efficient. Arbitrage is a key strategy used in derivatives trading, helping to ensure the market reaches equilibrium and that the price of the underlying assets are accurate. Derivatives also comes with transferable risk. Hence, using derivatives, risk can be transferred to other parties by investors, businesses and other people. As we discussed about the advantages of derivatives, we should also know that derivatives also come with some disadvantages. So, one of the main disadvantages of derivatives is it involves very high risk. Now we can also say that the derivatives contract are very risky since the value of the underlying assets such as shares is constantly changing. As a result, traders run the danger of suffering significant losses. Derivatives also comes with counterparty risk. So, as the futures contracts that are traded on exchange like BSE and NSE are example of derivatives contract that is organized and controlled. However, OTC derivatives, arrangements like those for forwards, are not standardized. Thus, the possibility of counterparty default exists all the times. Now, derivatives are very speculative in nature. Hence, contracts for derivatives are frequently employed as speculative instruments. Because of the considerable risk involved and the unpredictability of their value changes, irrational speculation frequently results in significant losses. So, this was all about derivatives, where we understand derivatives, their types, advantages and disadvantages. Hope our video helps you to get things to understand. Please like, share and subscribe the video. Thank you and have a beautiful day ahead.